Hello everyone, welcome to my channel, and today I'm going to be analysing a stock which I am interested in and to see if I can come to a decision on whether it is a buy, whether I should wait, or whether I'm just going to leave it alone altogether, and that is Starbucks. So yeah, but before we get started, please remember that this is not financial advice and I am not able to give out financial advice. Before investing in any stocks, you should do your own research and be prepared to lose your capital. I am purely doing this for information purposes and just so I can think out my own reasoning and to then hear other people's thoughts in the comments. So yeah, this is not financial advice. So I want to begin by looking at the recent performance of the stock itself. So over the last 3 months, it is down 24.5%, and that is mainly down due to poor earnings. So if we take a look at the earnings, this is from the earnings guy on Twitter. So as we can see, for Q1 of this year, they missed expectations of earnings per share by 29% and revenue was missed by 1%. Year over year, earnings per share was down 50% and revenue was up 2%. So that was very negative performance, and that is the reason for the stock. But if we go back to the stock, we can see that over the last 3 months, really, from that initial drop, it's slowly started to get some consistency. Obviously, the next big news is the next earnings report, which will come out in July, so I might wait until then. But on recent performance, it is down, but let's look into it further. I like to take a look at the fundamentals, and as we can see, earnings per share, if it has been rising and then fallen, which is a bit of a sign, bad sign. But over the last 5 years, they got 20% growth for the earnings per share. So yeah. However, if we look at their financials overall, revenue over the last 5 years has increased 36% and is due to keep on increasing. Operating income has been on a bit of a up and down trajectory, but it looks like we'll see some more downside before we see some upside. But over the last 5 years, there's still been 31% growth. Net income is similar, as you would expect. It's on the same trajectory. Earnings per share, we've already looked at that. Operating cash flow, it is steady. I would like to see that increasing, but it's steady, which isn't the worst thing. And then free cash flow, really not much growth in terms of free cash flow, which as a dividend paying stock, that in my eyes, if they're not growing that free cash flow, that dividend is not safe. They might not decrease dividend, but it certainly means that they might struggle to increase the dividend, and that's what you want to see. You're not going to invest in a stock if there's no dividend growth, because then inflation leaves you behind. So when you're looking for a stock, if you're investing for dividend purposes, you need to always look for the dividend growth to be ahead of inflation, and for a company to allow that to happen, it needs to keep growing its free cash flow. So if we look at the balance sheet, I haven't actually seen this in any of the companies I've looked at before. So for the first time, assets is outweighed by liabilities, which means if worst comes to worst, they could not sell everything within the business and cover their debts. So it'll be interesting to see if they're paying down that debt. Hopefully I'll get that information. But yeah, it's the first time I've seen that. Now, if we look at these figures, this is what I'm interested in a lot more. Gross margin is around 25% and it is steady up until 2023, 2024, and then steadily declining. So you'll see the same in operating margin, net margin, free cash flow, as you can see here. And since COVID, it's not recovered and it is just decreasing. Now there might be a different well, it's not good overall, let's be honest. Another thing I like to look out for is return on invested capital. So that's sitting around 13%, which is quite good. A good company should see at least 10% return on invested capital. If you get a company that's 20% or more, then it's a great company. So they are seeing good returns for their investment, which is a positive sign. The next thing we'll take a look at is analyst expectations. So as you can see, on a worst case scenario, they're going to go down 13% over the next 12 months. On an average forecast, there's a 11% upside, and then on the highest forecast, if they can really turn it around and see some positive change, there's a possible 56% upside. Obviously, analyst targets aren't a forecast of what is to happen, and quite often they're wrong, so don't take that as gospel. But yeah, nice to say that there is some upside that can be seen, but take it with a pinch of salt. And if we look at the dividends and shareholder yield, so the dividend is a 2.84%, so that's quite a good starting dividend yield, if I'm honest. And that is grown, so 3-year growth has been 25%, 5-year growth has been 50%, 10-year growth is quite good. 7% growth over the last 12 months. I wouldn't mind, if I was invested as a stakeholder, for them to slow down the growth. Keep in line with inflation is fine with me, if that's going to allow them to sort out the business, especially if they would use that money they would save to pay down more debts, because as you can see, they've currently got more liabilities than assets. And this website, Alpha Spread, which is amazing by the way, rates the dividend safety as 41 out of 100, so it's unsafe. So if we look down here, total shareholder yield from dividends is 4.77%, and that's dividend yield plus buyback yield, which they haven't done, plus debt pay down, so they are paying some of the debt down, which is nice to see. Let's see if we can look at this further. So over the last 3 years, they had took on, well, they haven't took on more debt, they just hadn't paid it really, but over the last quarter, looks like it started paying off the debt. So to me, early signs, I would wait for the new earnings report in July just to see if they've continued paying down the debt and to see if they've been able to stabilize some of their finances or grow in the best case scenario. So I'm using the post here on Trading 212, which sometimes you can get some valuable insights like this. A lot of the time, the communities can be a bit tedious, but I want to highlight this section here. So US and China together represent 61% of the total global store base. The reason I want to highlight that is China consumer spending is slowing down and there's no signs of any recovery yet. Obviously, America at the minute, God knows what's going on. It's like a spinning plate and you're constantly just chucking stuff at it. Like, you genuinely don't know how it's going to react, what's going on. There was a phase of a recession, which have now been reduced massively. So that could be good. But the CEO, which I did read in the financial statement, which I do have up, but I don't like the format. It's not user friendly. So I have checked this against the financial earnings report and it is accurate to what is being said, which I don't mind. So that's why I'm using this format. It's just easier for your eyes. So the CEO has turned into confidence, is optimism, because of their Back to Starbucks plan. And this is their way of returning Starbucks back to what it was. And they're on track and see even more opportunity than initially imagined, which is quite good. And they said, the CFO has said, whilst our financial results are far from Starbucks' potential, we are working to build back a better business and we are developing new capabilities to test, iterate and scale quickly, which sets the stage for long-term durable growth. So that's positive. It's good to see that CEO and CFO are positive. Back to Starbucks sounds like a good initiative if they can deliver that. They're also reducing 1,100 support centre roles to streamline operations, which is quite good. So yeah, that is a positive among a lot of negatives really. I also want to look at the intrinsic value. So Alpha Spread gives you the intrinsic value of base case, worst case, best case. So at the base case scenario, it is currently 3% overvalued. At the worst case, it's 27% overvalued, and at the best case, it is 19% undervalued. So yeah, that's interesting for anyone who wants to know that. But don't take this as gospel. You are better doing your own calculations. Don't take anything from this video. But yeah, so my personal opinion on SBUX is, whilst I think they're taking a lot of steps in the right direction, we are yet to see any of them positive changes. Personally, I would like to see more debt pay down, and I would like to obviously see the earnings per share and the revenue to start growing. So I think for me, I'm not going to buy this stock yet. It's definitely going to stay on my list. There is potential here. I think obviously it's a risk waiting for the next earnings. The next earnings might smash it. The guidance might be good. That's another thing. Then they haven't give guidance until Q2. They didn't give it in Q1. So yeah, I think personally for me, I would rather wait to see how they perform in the next earnings before making that decision. I can see why some people will invest, and I can see why some people will stay away from it, but that all comes down to personal opinion. So let me know what you think in the comments below. Let me know if you are invested and you're buying more, or if you're invested and you're holding, or you're invested and you're selling, and what your plans are. So yeah, thank you for watching. Subscribe if you have enjoyed, and I'll see you in the next one.